Welcome to the KMG Fiduciary Partners Podcast. Here, we'll cover important topics on financial planning and asset management to help keep you informed and inspired for long-term success on your financial journey. Let's join the KMG team now for today's topic.
Welcome to the 10-Minute Advisor, brought to you by KMG Fiduciary Partners. My name is Rob Thompson, and I'm a CPA and wealth advisor with KMG. I'm here with Cameron Kaiser, who's a CFP professional and wealth advisor. So, Cam, how was the weekend?
It's pretty good. I'm excited for we're at the home stretch of wedding season right now. I think I've been in 5 so far. So one more to go, and then I'm in the clear for a few months at least. I know you've been in quite a few.
I'm exhausted. I had my own wedding this year. I had my younger sister's wedding this year. Some of my best friends. I think in total, and the numbers honestly I'm still counting, but I think I'm floating around 14 weddings for the year, which is, we had to say no to a few. We didn't even get to go to all of them.
You put me to shame, man. I feel bad complaining about my 5.
Well, I feel like we're in like wedding crashers, but we're invited. It's just we have a wedding every single weekend. And if it's not a wedding, it's an engagement party or something of the sort. So it's just that kind of phase in life and the age group that I think I'm in. But
again, no hate to anyone having a wedding out there. We're not, it's exhausting, but it's fun.
Yep. It's I think a lot of this is that everything kind of got backlogged due to the pandemic. People are starting to do things that they hadn't done in a couple of years, just waiting for the right time. So yeah. But hey, let's get into today's topic. Do you want to give the viewers an idea of kind of what we're going to be talking about?
Sure. So today we're going to get a little more advanced and discuss a few ways in which you can deploy your pre-tax dollars and turn them into Roth dollars. As always, we're going to try to provide as much information as possible on the topic within 10 minutes or less.
All right, and then Mark, can you go ahead and start the clock for us here?
Ready, start.
Sweet. Okay, so Cam, where do you want to start this?
Let's start off with just basic Roth conversions. Can you kind of give the viewers a little detail about how you go about doing that and maybe some info on it? Okay,
and I'm going to keep this short and sweet, or at least attempt to, because I can ramble. But what we basically do, what a Roth conversion is at its core, is getting our pre-tax assets that we've set aside or accumulated over the course of our lives and moving them into Roth. And by doing this, what happens in the middle of those two things is we basically have to pay income taxes on the chunk of money that we decide to move over to Roth in a given year. So this is something that I tend to wait until late November or even as late as early to mid-December, because that's when we have a really good idea of kind of where income is going to land. And what I'll actually do is run tax projections so that I can say, hey, maybe we take $25,000 out of your, whether it's traditional IRA, 401k, any pre-tax bucket of money. Let's recognize that money as ordinary income this year, meaning you're gonna owe ordinary income tax on that money. However, once we get it into the Roth bucket, we're able to let that money grow tax-free, and we don't have to worry about it anymore. Now, why does that make sense to do? Well, it really depends on where you're at in life and what you have going on, which is where financial planning comes into play. But what we tend to look at is just maximizing whatever marginal tax bracket you're in at the time. So let's say that you've got $30,000 of wiggle room within the 22% tax bracket. Well, given the current tax rate environment, it may make a ton of sense to go ahead and recognize that as income now, knowing that down the line you're going to be facing some pretty high income years, whether that's from just bonuses at work or something like a required minimum distribution starting to kick in. So that's longer than I wanted to go, but I'm going to turn it over to you. Let's talk about backdoor Roth. You want to explain to the viewers how the backdoor Roth works?
Of course, the backdoor Roth. This is probably one of the most, if not the most, asked about strategy we get from clients. And again, it's also kind of funny because people are a little hesitant to ask about it, even though it's a commonly asked question, because they almost think they're breaking some kind of rule because it's a way around the phase-out limits of direct Roth contributions. But it's completely legitimate. The IRS is well aware of it, and maybe they'll get rid of it in the future, but for the time being, it's completely allowed. And the way it works, and again, this really only works if you're either willing to convert your entire traditional IRA balance or you don't already have an IRA balance, because you come across pro rata rules. I don't even want to go into that.
That's a good point, though. That's important to know.
Yeah.
if you already have a traditional IRA with a balance, that does make a difference and impact the ability to do something like the backdoor Roth.
Yeah, it's really the one hurdle for doing this.
Yeah.
Right. So assuming you don't have that, let's say you have all your money is in a 401k and you don't have to worry about it. What you would do is you'd open up a traditional IRA and a Roth IRA. You would make a non-deductible traditional IRA contribution. Then once it's in there, you would make a conversion from that account into your Roth IRA. Again, keep in mind, even though there are phase-out limits for direct contributions to Roth, there's no phase-out limits for Roth conversions. So that's the way around it. And then once it's in that Roth bucket, it's almost as if it was a direct contribution. The only difference being that there's a 5-year timer. So basically, once you make that conversion, you have to wait 5 years until you can take out that principal, which isn't the case with a direct contribution.
Okay, and just to clear this up, clarify it as much as we can you explain why you would need to use the traditional IRA? Why wouldn't you just cut the middleman out here?
Yeah, and ideally, that's a good point, because ideally you would want to make a direct contribution, not worry about it, less messy, just straightforward, right? This is for high income earners that aren't eligible to make a direct contribution. It's just a way around that phase out rule. So, Rob, now that I kind of talked about backdoor Roths, do you want to get a little more complex and talk about the mega backdoor Roth?
This is probably my favorite, I guess, topic when we're talking about Roth, because there's a lot of strategizing that goes on behind this. But I think it's important to start here. So within a 401k plan, and typically these are the three options, but sometimes they're not all there. So we need to make sure that we have these options available to us in order to even consider doing the mega backdoor Roth. But if we can, it really is mega. So the kind of traditional pre-tax bucket we know about in the 401k, the Roth bucket, so the after-tax money that we put into the 401k, that's the second bucket. The third is this post-86 after-tax bucket of money, and basically that's a blend of both Roth and traditional or pre-tax money in the 401k. So the post-86 after-tax bucket is where money goes in after tax. However, that money will actually grow tax deferred, meaning it grows like a traditional IRA, essentially. So once we go fast forward, 20 years down the line or whatever that may be, you're going to actually have to pay ordinary income taxes on the earnings within the post-86 after-tax bucket, not the contributions, just the earnings. So the mega backdoor Roth works, and we can utilize this if, first of all, your 401k does allow for in-service withdrawals of that post-86 after-tax bucket of money. Number two, you have to have post-86 after-tax as an option, as a contribution option. But what we do is we say, okay, so first we're going to max out to the IRS limit, the $20,500 for 2022, right? And then what you're actually able to do is go above and beyond that IRS limit by contributing money into the post-86 after-tax bucket. So if you're keeping track at home, we've got $20,500 that's going to meet the IRS contribution limits for the pre-tax or the Roth portion of the 401k. However, we're able to put another, what's the number?
40,500.
Yeah, okay. So this is for somebody that's really serious about stepping it up a notch and really putting the pedal to the metal in getting money to not only just, growing tax-free, but just setting money aside in general, right? Because when we're doing the math here, if we combine both the employee and the employer contributions to the 401k plan, that means you could get roughly $61,000 into the 401k in any given year. So that's awesome.
Yeah, I think it's important to keep that number in mind too, because the 61,000 is, like you said, it's a collective amount between your Roth / tax deferred amount, that 20,500, and then on top of that, your employer, the profit share, employer match, all that stuff, and then the 86 after tax amount.
Yeah.
You don't want to go over that, and that's if you're kind of on the line or not sure, you'd talk to a professional to make sure you're doing it correctly.
Yeah, and it's important if you do elect to begin doing this sort of mega backdoor Roth strategy that you stay diligent in terms of actually getting into your 401k account, whether it's on a semi-annual basis or an annual basis, but relatively frequently, and making sure that you're rolling any money that goes into that bucket, the after-tax contributions, out directly into a Roth IRA. Otherwise, what happens is if that money begins to grow, if you have it invested or whatever the case may be, again, the earnings on that are growing tax deferred. So all you're doing is setting yourself up for more income taxes down the road when that's a totally avoidable situation.
Yeah, I don't know about you, but I'd want to pay as little taxes as possible.
Yeah, I think everybody would agree with that.
Coming up to our time.
All right. I think I'm good. Do you have anything that you want to cover?
I think we cover enough. Again, if you guys have any more specific questions about this or you want us to go in more detail, we'd love to meet with you and help you out. Again, these can all be a little different depending on your individual circumstance. But our informations and contact information is below, so please reach out if you have any questions. Thanks for joining us for this edition of the KMG Fiduciary Partners podcast. We invite you to catch the next episode in our series for real-world advice from the KMG team. Follow us on LinkedIn at KMG Fiduciary Partners, where we'll keep the conversation going.